Okay, well, thanks everyone for turning up for tonight. So when we thought about this seminar a few weeks ago, when there was a few items came up, it was a little bit surprising with regard to superannuation. And as we're thinking about it, putting it together, we decided, well, let's put it off for another week and throw the information on the budget in together as well. So we might as well just fire up from now. So first thing I've got on there is don't believe anything I say tonight. So with this one, again, this is just general information. We'll see how the whole operation works. Okay, what we're going to run through tonight is the budget initially. So with this budget, we're going through the overview, then how it affects individuals, businesses, and then government grants. So just on various different items there. Okay, so the first one, the big thing with this side of things, is the biggest change this budget for 18 years. So we've had for quite a long time, since 1997, they've really been much of a muchness all the way through. Had a couple of big ones, but this across the board is a fairly major item there for us. The big one that probably people may have heard of in the last 2 days is the single biggest item in this is the way that they're going to try and push a whole heap of money back onto the states. So the budget numbers, when they talk about the actual numbers themselves, are normally only looking at the next 4 years. But it's beyond that, from years 6 through to 10, where the government have effectively said we are not giving the states $80,000 million that they thought they were getting to match up with the education costs and the hospital costs. So when you work back through the numbers, that's about $13,000 million a year. We get about $60 billion a year out of the GST. That works out to be, it'll work if the GST goes to 12.5%. And that's what they're aiming for. So with the GST, the legalities behind it is that they can only increase the GST or broaden it, so put it onto health or education or other things, if the states, or all the states and the federal government agree. And so what the feds are trying to do here is to starve the states into submission to hopefully try and say, please increase the GST for us. So that's a bit of political backside covering they've got there. Rightio. The other big item in here is that this is really just a government wish list. And normally that's the case, and normally that's not really a drama because they'll get it through the Parliament, they'll get it through the Senate. And I'll run through in a moment now as to why I think it's a bit more of a wish list than it normally is. So this is who we've got in the actual Senate at present. So you can see that here, this is what our numbers are today. This is what our numbers are after 1st of July. You need to have 39 votes to get something through. So you can see last year, we had 40 votes between the ALP and the Greens. So that's why Julia signed up that deal with the Greens, so she could get all of her stuff through. And that wasn't a problem. This year, if I've got 33 and the Greens, so I've got the Coalition and the Greens, I pass. I don't think I'm going to get too much agreement between the Coalition and the Greens. So therefore, if these guys got 33, we've got to get 6 out of these people. So out of those guys, Clive's got 4. So he's got 2/3 of. If you get Clive, you only need 2 others to come across. If you fail to get the ALP and the Greens, and I know I saw an explanation a couple of weeks ago about all these individual guys and what their thought process was on 15 or 20 different specific policies, and they were all over the joint. So no one agreed. There is no one block. You might have 3 guys agree with one thing and 3 on completely the opposite side, and then 2 lines down, it was completely different again. So think of the schmozzle that we had in the main parliament last year, up until last year. We're going to see that in the Senate for the next 3 years. That's my gut reaction. So some of the items that I'm going to run through, I'm going to say this is what the government wants to bring in. I've got no guarantees they're actually going to come in. The other big item on here is just looking at the overall big picture. So these numbers have come out of the actual budget estimates. I haven't seen them on any TV show or anything like that. So you can see over here, this is what in the 2013 budget, so what Wayne Swan brought down 12 months ago, this is what he thought was going to be happening in the 14-15 year. Over here is what Joe Hockey thinks is going to be happening in the 14-15 year. So this is after Joe Hockey has done all these changes that we'll be talking about now. So you can see here, taxes are actually dropping by $17 billion. And with all the changes to the expenditures, virtually no difference. So what's happened is that the underlying side of things is still going down just a little bit, and Hockey has had to turn around and work it so much harder to make sure that the bottom line is staying roughly stable. Now, this shows it's not as bad as these numbers look, because I've left out a line of other non-tax revenue for the government, but you can still see that the major issue is that even with all these changes we're throwing through, they're really just sort of standing still, if not going backwards still anyway. Okay, so the first thing I'll run through is just income tax rates. So as you can see in here, that's this year. Next year, the only change in here is from 45 to 47%, so this is the so-called deficit levy. So it only impacts on your income above $180,000. The other item is the Medicare levy. Was 1.5%, it's now 2%. So effectively, if you've got taxable income over 180 grand, it's really a 49% total combined tax rate. Only other changes coming up here is the tax-free threshold goes up, and then this next threshold, the tax rate also goes up just slightly. So effectively, the amount of tax that someone's on $80,000 is paying in 2016 compared to 2015 is differs by about $30 or something like that. So it's very minimal. So that's been the big changes that when John Howard was in vogue, they changed this schedule every year for about 7 years in a row. So this is probably one of the really minor changes. Okay, next thing that affects individuals is the Medicare safety net. So this one is where you go to the doctor, if you go there for 10 times in a row, or go to the pharmacy, you might be paying $40 a script up until a certain amount, and then all of a sudden the price goes down to $7. So there's about 15 different systems of this Medicare safety net at present. They're going to cut it down to about 3. So effectively, if you've got for a non-concessional family who's not on family tax benefit, first $1,000 you spend at the chemist, you have to fork out at that top price, and then you start getting discounted medicines and whatever. Okay, different cancelled programs. So we've got in there something called dependent spouse offset, which is effectively the spouse rebate from years ago. That's gone now, as well as about 7 or 8 other dependent spouse offsets, as well, just dependency offsets. So it can even be a daughter-in-law offset, I think it was something like that in there. There's about 7 or 8 of them. We do about 1,500 individual tax returns a year in our firm. I think I've seen over the last 5 years about 3 individuals of these offsets gone, so it's not all that relevant. Mature age worker offset. So this is where if you're over 65 and you are working inside a business, you actually got an extra discount off your tax. They quietly let that one go through to keep it this year. The National Rental Affordability Scheme. So this is where if you have, in other words, you could register with the government and you would agree that, right, this rental property that I'm buying that had to be built fairly well brand new, this rental property, it will be rented out at least 20% below the market rental. If you agree to do that, you could get up to $7,500 a year for 10 years from the government. So it was quite a few bells and whistles you had to sort of flow through to get into that. That one's been knocked on the head, so it's not happening anymore. And the other one is the First Home Savers account. So this is where you actually effectively got money set aside, and was any interest on the monies were tax-free. If you were under about 25 and you had to put the money aside, you could only use the money towards a deposit on a housing loan. I believe that because the restrictions were so severe, if you didn't put the money into a house within 6 years, you had it then flowed into your super fund, and therefore you're effectively saying to people who are aged 25, put the money in or throw it into super. I think there was about less than 100 people took it up in Australia over 3 years, so they whopped it out. That was one of a big song and dance about it about 3 or 4 years ago when Mr. Rudd brought it in. Okay, this one will affect probably not many people here, but it might affect your children. So with the help, so this is the old HEC scheme, or the loans for to get money for your education. That's coming in a little bit earlier. So now, once your taxable income's over about $50,000, you'll be paying at a rate of 2%. The other thing is that the indexation, or the debt increases alongside the bond rate now rather than CPI. So that's going to be quite a bit bigger. So currently the bond rate is at 2.75%. CPI was closer to 2. So it's just going to accelerate a little bit faster now, that's all. This one here, the next one is something that's actually a pretty good idea. So HECS was always only for uni students. What they've got now is anything that's effectively for the tradies. So if you're doing a Cert 3 or a Cert 4 course and it's on the wanted list effectively, they will now give you up to a loan of up to $20,000 over the 4 years as an advance to help you sort of survive. So effectively a first year electrical apprentice and sweet bugger all. And so they'll say we will lend you up to $8,000 to be able to help you survive along the way. So it's actually a pretty good idea. So again, it's only on certain restricted items. So I'm pretty sure that there's about a third of the courses are actually covered. If you actually successfully complete the training, so you go through your full 4 years, they actually get a 20% discount. So they might borrow 20 grand, they only have to pay $16,000 back. But if you only go through 3 years and by then you borrow $16,000 or $18,000 and you pull out, well, then you've got to pay the full amount back.
Is there any time frame on the repayments there?
No, it's exactly the same as the help scheme. So the help scheme is based purely on your taxable income. So once you're at over $50,000, so I'll just run through that again. So if you're at $50,000, you'll be paying 4% above your amount. Between 50 and over 54, it's at 4.5%. So what this means, this goes on top of your tax rate. So if you're someone who's got a whole heap of money, who's been at university and you might owe $50,000 in your HECS debt, and now luckily you're on a $200,000 salary, you're paying 47% tax, paying 2% Medicare levy. In this case, you're paying 8% help debt. So it's 57% tax rate. So it adds up pretty quick. But by the same token, these items only come through once you are earning more than the average income. Okay, superannuation excess contributions. This is actually a fairly good thing that comes through for us. So at present, putting money into superannuation, we've got two ways to do it. We can either get a tax deduction to put it in, and that's a maximum of $25,000 a year, or we can do what's called a non-concessional contribution, which is $150,000 a year. Next year, that 150 grows to 180. Now you can also do 3 years of that non-concessional together, so you can actually put in 540 this year, but nothing next year and nothing the year after. Now the current rules are that if you put in too much, so let's say that I wanted to put in 540,000 and by mistake I put in 600,000 somehow. That's because I forgot that I put in some money a little bit earlier. If I do that on that excess, that's $60,000 excess, potentially we're up for a 93% tax rate. So that's pretty nasty. And at present, there is nothing we can do about it. We actually had two or three different clients being hit with this, one of which was where they pulled money out of the super fund and then put it back in, talking to Q Super, the people had told them to do that. And then later on, they'd come in and these guys they pulled out 190, put it back in, 190,000. He was only allowed the 150 that year because he was over 65. $40,000 excess, he gets a $20,000 bill. And that's the first that we even knew about it, was like 6 months later. And we tried to go through and say, hang on, he was given advice by a Q Super to try and do this. Zero help from the tax office. I said, too bad, $20,000 bill. Okay, so it was pretty nasty. So what they're doing now, they're now allowing us to say, righto, within 12 months, after you put that excess amount in, as soon as you find out you've done it, you're allowed to pull it out, and you're also allowed to, share of the income of the super fund that's been generated because of that extra money. Let's say you put in $100,000 too much, you had $300,000 in the fund, so therefore a third of the interest that the fund earned during that year, you have to bring that into your own tax return as taxable income and pay tax in your own rate. So it's really quite a good thing, this one. So that makes our life a fair bit easier, because I don't have to tell anyone I've got some nasty big tax bills that I weren't expecting.
So you don't get the money individually, but you pay tax on it individually?
Yeah, you're allowed to pull the cash back out, because we weren't going to get a tax deduction for it in the first place, because this is the non-tax deductible amounts we're putting in. At present, for the amounts that you claim a tax deduction on, which is $25,000, that amount you're allowed to pull out and get pulled back out up to a maximum of $10,000 once in your lifetime. And again, it sounds good in theory, but in practice, it's a damn nightmare. Okay, FBT, that's gone up from 47% to 49%. We were thinking there was going to be quite a few changes to FBT, and nothing's happened, so it's pretty simple. So there's really not much there. Employee share schemes, nothing's happened on them either. So what we've been aiming to have is for changes to systems that allow employees to buy shares in the business they're working for. There used to be quite a few benefits that were available that the Labor Party knocked on the head about 4 years ago. They were supposedly bringing them in. I believe they're coming through in September or October this year, but we haven't seen anything yet. So I've got a couple of clients that I'm holding out, waiting to do something to try and... It's a very good system if you can have your employees share the same benefits and downsides that you do as a company owner. Private health insurance. So this one here, this is where if you have if you've got private health insurance, you get a rebate that I think that Costello brought in, and then they've sort of culled it back a little bit, so that if you're a single and you're under 65 and you're earning less than $88,000, so this one here, you get 30% rebate back of your price. So if you spend $3,000, you'll get $900 back through the tax system. Now, obviously that reduces as your taxable income goes down and increases as your age goes up. So, but if you're on more than $136,000, you get no rebate. Now, what happens for a lot of people, they claim their rebate through the health insurance fund. So they have said in previous times there was none of this, everybody just got straight 30%. And the health insurance fund said, right, your bill was $3,000 less 30% rebate, so we'll only give you a bill for $2,100 a year. You've paid your $2,100, turns out your taxable income's $140,000, so you're not entitled to any rebate, so therefore I give you a $900 bill as part of your tax return. So that's what this is about, and they've just changed the thresholds a little bit there. The other side, you said, well, I'm getting no benefits, bugger it, I'm not going to pay private health insurance. On the other side, if you don't have private health insurance and your income's too high, you'll be hitting with an extra surcharge on your Medicare levy. So again, if you're over $136,000 taxable income, you get an extra 1.5% on your Medicare levy. So we're actually at 50.5%. So the standard Medicare levy is 2% for everybody, plus your 47% if you're over 180 grand, plus this 1.5%. So we're actually 50.5% is our maximum individual tax rate in that scenario. Fuel excise levy. So this is a big one that came through there. So what happens with fuel excise is currently everybody pays about 38.1 cents per litre as an excise, as an extra tax as part of our fuel. That 38.1 cents has stayed unchanged since about 2001. What they're now bringing in is that 38.1 will increase alongside inflation. So if you've got inflation of 3% a year, that works out to be about 1 cent a year increase. So that's going to come through every 6 months. This thing starts in August. So in 1st of August, the pump price in theory goes up by 0.5 cents a litre. I know for myself, I'm out of Ashgrove. When I'm driving in here, the difference between my cheapest and my dearest fuel price is about 15 cents a litre, depending on what time in the fortnight it is. So this is going to push it up by 0.5. So from my point of view, it's equivalent. It'll take 15 years of this to change, to match up the difference in the best day that I buy the fuel. So it's not going to affect me too much. But it will eventually over time sort of bring it through. What they're trying to do is to make sure that the value of the fuel levy doesn't stop. They're also supposedly trying to say that any extra money they raise through this will be linked to road funding. For farmers, they will get all this money back. So at present, the diesel fuel rebate is 38.1 cents. Come August, it'll come through at 38.6 or something like that. So it's not going to affect the farmers or miners at all. And there was a fair bit of thought process that was going to happen. Company tax rates. So this is actually in the budget notes as an aspiration. So what the hell that means. So currently everybody's paying 30%. From 1 July 15, small companies are going to drop down to 28.5%. The larger companies are going to have an extra 1.5% paid parental leave levy. So for Tony Evans' paid parental leave, the big company is going to be paying 1.5%. Now the definition of a big company is someone with income over $5 million. I don't know whether income of $5 million means assessable income or sales or taxable income or somewhere in between. And I don't know at present whether you would pay that higher 1.5% just on the amount above 5 million if it's taxable income, this is what I think, or if you're 5 million and one, all of a sudden you're hit with an extra $75,000 bill. Unfortunately, all those items haven't been thought of yet, I don't think, but that's what they're talking about there. Also, I don't know if that extra 1.5%, if you would get on that one there, if you get imputation credits on it or not. I doubt it. And that means for all the dividends you'll be getting from 2015-16 onwards, you would only get imputation credits at 28.5% of your dividend, not at 30%. So that's how that'll probably affect most people. Right, the super guarantee rate, this affects everybody as well. Currently it's at 9.25%. It's going to go to 9.5%. And that'll go through from 1st July 14. Supposedly it's going to stay unchanged for 3 years and then gradually drip up to 12% by 2022. Now, SME depreciation. So this affects a few people in the room here. This is one, they didn't actually talk about this at all, and therefore I've got no idea what's happening. So what we've got in there at present, if you've got buying an asset for less than $6,500, so it's like buying a computer for $3,000. Because it's under $6,500, if you're a small enterprise, that means your turnover is less than $2 million, I can claim an outright tax deduction for it. Prior to these rules, it had to be under $1,000 at that threshold. Also, if you're buying a motor vehicle, the first $5,000 we get is a complete outright tax deduction. Now, Tony Abbott tried to knock this on the head and say that these rules were gone from 1st of January, and so that for a motor vehicle I just claim normal depreciation the whole way through, and I don't get, it means depreciation is only $1,000, not $6,500. He lost that at the first time because he tried to link that with the reversal of the carbon tax. He said we can't afford it because of the carbon tax being wiped out. That's been knocked back. I don't know if the carbon tax is going to stay or going to get wiped out or whatever. So I don't know if you bought a computer today and your turnover is under $2 million, spend $3,000 on it. I don't know if you get a full tax deduction on the whole price or you have to depreciate it. Hopefully I'll find out before we start doing next year's tax returns. So at present we get a full deduction. My guess is we'll get it all the way through to 30th of June 14 and then I'll go from there. But that's my guess. Okay, R&D rates, so research and development. If you jump through the hoops and can pass the rules for research and development, you get a big extra tax deduction. So on $100,000, previously we used to be at 45% for most of our clients, that one there. So on 100 grand, if you spend $100,000 on fuel, you save $30,000 in tax. Spend $100,000 in R&D, you save $45,000. It's quite a few. It's quite difficult to get through. You need to be a company to do it in the first place. They just dropped the rates from the discount rate from 45% for most of their clients down to 43.5%. Turnovers over 20 mil goes from 40 to 38.5%. Okay, new employees over 50. So if you employ someone who's over 50, the headline was you can the employer can earn up to $10,000. There's a few hairs on that. First of all, the guy's got to be unemployed for at least 6 months first. And then with your $10,000, you then only get $3,000 after 6 months, and then another 3, then 2 lots of 2. So effectively, for you to get $10,000, he's got to stay as an employee for 2 years. So that's all that's going there.
Well, that gets pretty personal in the interview process, Terry. So how long have you been unemployed? Oh, 5 months. Oh, next candidate.
Yeah, that's sort of it. They've got to be on, I think, some sort of new start program or something like that to be able to qualify for it. So again, this is the sort of thing that makes the politicians sound good when they say it, and they're not actually going to give up any money. Entrepreneurs Infrastructure Program, I only put this in place because there may be some impact for some clients in the year. If you've been dealing with any of these type of things, all these have been wiped out and have been replaced by a new name. So it's someone different to talk with. So again, any sort of government grant that you're dealing with, that you can come through. Now, we've had clients who've earned over $1.5 million through a Commercialisation Australia grant over 18 months. So sometimes if you're going into something new, this can be some pretty decent sort of money. They're actually spending about $400 million over 4 years on this one, so it's actually it's a decent size operation. Pension age, so this is another one where people are jumping up and down a fair bit about it. You can see that what the Labor Party, and Bill Shorten's saying this is terrible, Labor Party actually brought that in last year. So from there, that's what the Labor Party have done. All they've done now is they've just extended it. You can see that as you're going about every 18 months, as you get 18 months younger, your age goes down by, your age increases by 6 months before you're entitled to the age pension. So again, for myself, I'm younger than 1966, so I'm not going to get the age pension until age 70. And again, with these ones, with the Greens and Labor, I think they're not going to like it too much, and who knows what Clive thinks, it may not come through. But eventually, my gut reaction is by the time we get to, was it 2032 or 2036, I think it'll be in place by then anyway. It's my gut reaction. What they will also do, they haven't linked in as yet, but they will make the age that we can pull our money out of super more closely linked in with this as well. So my guess is that by the time we get to 2035, for me, at present I can get access to super when I'm 10 years younger than the age pension. So I think it'll be age 60 before I can get money out of super, for myself as such. So someone like me gets away with it straight away. So. Age pension, future increases. This is also another big hit. This only comes through in about 2017, but they're actually increasing the age pension in line with inflation rather than male weekly earnings. So the reason that, because apparently we've got overall wages, but our men's wages are increasing faster than women's, and so at present the age pension is based on male weekly earnings. So that's running at about 3.5% compared to around about 2.5% for the CPI. Something simple like that, I reckon, is going to save them $1.5 billion a year over about 3 years. So it's pretty hefty that it comes through there. But again, it's another way of hitting the pensioners. So there's no change to the assets tests, the income test. So for instance, to get family tax benefit, it may have been previously, I think it was about $146,000. The year before was $145,000. It was increasing alongside inflation. Now what they've done, they've said, right, for family tax benefits effectively, and new starts unemployment, those income thresholds will stay frozen for 3 years. But then from 2017, they're not going to freeze these ones, which is the pension items, but in 3 years' time they will then freeze them for 3 years. So again, it's just a way of gradually saying we're making it tougher to get payments from the government. Pension concessions. This is another big one, a bit of a sleeper. I haven't heard too much complaints about this one yet. Currently, what they're doing is the federal government gives a certain amount of money to the states to cover the costs that the state incurs for giving discounts on, say, car registration, public transport rates, electricity, that sort of stuff to age pensions. So what they're doing, they're knocking back $1.3 billion to the states over 4 years, so the states won't have the money to give these discounts. So this is another way that they're going to say, well, hang on, New South Wales and Queensland, ask us to increase the GST, so you get all, because the states get all the GST money. So that's why they're wanting the states to ask them to increase the GST, so they've got some more money to go through and placate the pensioners as such. So it's a bit of a, it's putting a squeeze on the pensioners and hoping something else squeals. Seniors health card. So if you're aged over 65, you're entitled to a healthcare card. If your taxable income's under 40,000 for an individual, under 80,000 for a couple. Now at present, that's just based on taxable income. So going forward from 1 July 15, that income will also include any tax-free withdrawals from a superannuation fund. So at present, withdrawals out of super fund don't count, and I've got clients who have got withdrawing $500,000 from super, and in theory, they can actually apply for this. This will knock them on the head. Okay, family tax benefits. This is actually the biggest single lot of changes all the way through the budget. It's going to save them about $2.5 billion a year. Some of them from 2014, most of them from 2015. The biggest single item is this one down here. So family tax payment B, this is where you've got hubby in the workforce and wife at home looking after the kids. At present, you're entitled to that if the wage earner is earning less than $150,000 and the youngest child is under 18. From 1 July 15, that 150 drops down to 100,000, and the child's age drops from 18 to 6. So that's a pretty big. So that's actually going to save them a fair bit of money by doing this. Again, it's only from 1 July 15, so it's not straight away. And another one, this is not going to affect anyone in the room, but it might affect your kids. So first of all, if you're under 25, you don't get the unemployment benefit, which is called New Start. You get the youth allowance, which is about $50 or $60 a week less. So currently it's under 22, they're going to bring it into under 25s. If you're under 30 and you've never had a job, I don't know the definition of what is having a job, you've got to wait 6 months before you get unemployment benefits. So if you come out of university, you haven't worked at university, you can't find a job, you don't go on unemployment benefits straight away, you've got to wait for 6 months. So that's going to take them a fair while, that'll hurt a fair bit. So the bottom line is, kids are going to stay at home longer. That's what's going to happen there.
So at the moment, there's no wait time?
There's a minor wait time, but so nowhere near 6 months. I think they're going to bring in a wait time of at least 1 week on virtually every benefit through the government system as well. Okay, university fees. At present, all university fees are basically they're equal across the board. So if you're doing a law degree at QUT or at Queensland University or somewhere down in New South Wales, they're all the same price. It might be $2,400 a subject or something like that. And then some of that money is covered by HECS and some of it might be, and the government sort of covers themselves. What they're bringing in now is from 1 January 16, they're saying the universities can set their own prices. And what that's going to do, it's going to increase the price of somewhere like Queensland University as opposed to USQ or Griffith. Because if you go to me as an employer, when I'm sitting down seeing someone's resume, I don't care whether they've gone to university as long as they've got a degree. But in China, it's massively different. Nobody's heard of USQ, so they don't want to be there. But UQ or University of New South Wales, it's in the top 100 list in the world. That's where they want to go. So therefore, the price to get a UQ degree will go through the roof once this comes through here. So that's coming from 1 January 2016. And so I know that one of our staff had already decided that, right, if we're going to do a master's degree, we're going to start before 1 January 16 because the prices for postgraduate degrees are going to go up substantially.
So the universities start funding their own themselves versus relying on the government for funding? Yeah,
so that's part of it because the government is also at the same time with reducing the amount of benefits they're giving, the amount of payments they're making to the universities. So they're doing two things at once. They're saying we're not giving you as much money, but also we're letting the brakes off and you can charge what you like. And so therefore, how much of that will still be covered by HEX, but it's quite possible, and I can see that in 10 years' time we could have people with a $200,000 HEX or health bill. Okay, this is probably the biggest public item on there was the Medicare changes, or the Medicare payments. So now it appears that you'll have to pay, what they want to do is they want to force you to pay $7 to see a GP. The GP will get $5 less from Medicare, so he actually gets to keep $2 for the hassle of looking out of collecting $7 for everybody. I don't think they'll make any money out of that. I think it'll be more of a hassle than that's worth for the poor GPs. Healthcare card holders or children under 16, once you've been to the doctor for 10 times for the year, after then it's free. So, and all this money supposedly will fund a medical research fund, which is saying by 2023 be worth $20,000 million. I've got grave doubts this will go up. I'm pretty sure I've heard Clive say he's not going to go for it, and the other two, for charging $7, guarantee that the Greens and the Labor Party will say no. So that, I can't see it. If the Greens and Labor say no, they can't get it through now, and Clive says no as well, they can't get it through after 1 July. So some of these items you go through there and say, well, I told you this is what they're wanting to do, but as I said there before, this is just a wish list rather than any actual numbers that we know can happen. So, okay, I'll finish that and I'll get Cameron to come up through now.
Just a quick question on that one,
Yep.
sorry. Does that mean there will be some doctor surgeries out there that'll still have the ability to 100% bulk bill if they want to, but they'll just need to crank out a little bit more people through the doors that day?
I think that what the understanding of that side of things is they will require that you will have to collect this $7, because you're right, in theory, if they're saying that we want
it's
you
just
to
a
push
reduction to them, they can then just say, well,
yeah, with that one, we don't know what the legislation will say yet, but effectively if they are, the only way to make it work the way they want to work, and not what you're talking about, is they have to put in legislation that you must collect a minimum of $7 every time you see someone.
yeah.
Now, I've never seen that legislation anywhere for any other business in Australia. Doesn't mean they're not going to do it though. Right, I'll put you over to Cameron.
Okay, I'm going to run through some of the super streaming legislation that's just come out recently that's going to be a reasonable impact. But before we do that, has anyone in here actually heard of super stream? Hands up. Apart from the staff at Marsh. The only reason you guys heard it is because we went through it on Monday. Okay, so basically super streaming is going to impact on pretty much everyone in this room. The concept is to initiate an electronic payment system between employers and superannuation funds. That's all superannuation funds and eventually all employers. The idea here is that when an employer currently makes a payment into a superannuation fund, they can have a time gap between when they've got to put the money in and when they've got to notify the super fund of what they're actually making a contribution for. This is to align those two so that when the money goes in, they are sending electronic payment notification to the superannuation fund to specifically say, this is what I'm paying you for, and this is the amount, and this is who it's for. So the main idea behind this is to try and get some efficiencies in the administration of superannuation system at the moment, and try and get rid of the massive lineup that you see outside Sun Super on the 29th or 30th of June with everyone sitting there with their cheque to give to the trustees so that they've met their super contributions for the year. You won't be able to do that anymore. So what's going to need to happen? So the contributions, as I said, they must be made electronically. No more cheques, no more cash, everything must be done by EFT. The details of the contribution will be provided electronically. So when you make the contribution, you're going to need to notify the super fund, is it a taxable contribution? Is it a non-deducted contribution? Is it a spouse contribution? You're going to need to know this at the time of making the contribution. And it applies to all superannuation funds, including self-managed super funds. So that's why everyone here could be impacted by it. Now, there is an exemption in there which is supposed to help out the superannuation industry, which is if you are receiving a contribution from a related employer, then you don't need to do this. The trick part with that is not everyone's employer is necessarily related. If you own less than 50% of the equity interest in your employer, in the company that pays your wage, it's not going to be counted as an associate. So if you own 40%, it may not be counted as an associate, and you're still going to have to go through this system, even though it's your business paying your super. So when's this all going to come into place? Originally speaking, it was supposed to be on the 1st of July. Superannuation funds would need to be registered to start receiving these contributions. And on the 1st of July, medium to large businesses were going to need to be registered. Basically what was happening was no one out there had any idea what was going on, as is evident by one person sticking their hand up. None of the software providers were ready, and the main reason none of the software providers were ready is the government had no idea how to actually get it to work in the first place. So there was a long time delay. We are only now starting to see that the superannuation system that we use to administer all of your funds is only just getting to the point where we can actually get this ticked off for your funds. So we're only barely getting there, and a lot of the accounting packages from an employer perspective aren't there yet. They can't handle it. So it got delayed till the 3rd of November for medium to large employers, and then everybody else will kick in on the 1st of July 2015. So it doesn't matter if you've got 1 employee or 500, come 1st of July 2015, you'll need to be ready.
What's the medium? What's the size of employer?
So the medium to large was, sorry? 20, yeah, 20 employees. So if you've got more than 20 employees in your business, from the 3rd of November, you'll need to be ready. Is there a possibility that date will be pushed out again? Yes, but I would try and get yourself ready for it. So a lot of people might be thinking, well, this sounds like a big headache. I can't be bothered. It's all too hard. I just won't worry about it. If we go down that route, from a super perspective, you can't receive the contribution. You'd effectively, if it came into the bank account, you'd have to hand it back. You're not allowed to keep the contribution. If you did keep the contribution, you're up for a $3,400 penalty per contribution you've kept. From an employer's perspective, there will be penalties. We just don't know what they are yet. But there is scope for them to bring in penalties around this. But critically, you can be prosecuted. So this can be considered under the Criminal Act. So from an employer's perspective, when these rules kick in, you need to be ready. So what do we need to do? Employers, you've got 2 things that you need to be complying with under the system. So the payments need to be made, as we said before, made electronically to the nominated super fund for the employment contributions. So you'll need, to be able to do that, you're going to need to know the contribution amount, which you should be just calculating anyway. The name of the employee, hopefully we all have that. Tax file numbers, again, we should all have that. And the super fund member number. You may not necessarily have that at the moment. If you don't receive information from your employees that you're going to need to complete all of this in time, now that says July 1, really for employers now that's the 3rd of November, you need to then make the contribution to your default fund. So because you don't have the information is not an excuse to not use the system, you just have to put it to somewhere where you know the information. So from an SMSF perspective, so for all of us sitting here today, what do we need to do? So we need to provide to the employers our ABNs, the bank account details, which they probably already have anyway, and an electronic service address. Now this is a new concept. This is what we need to register once our systems are up and running for every fund in here, and we'll send out notification once it's available. Effectively, it'll be a series of numbers or letters which will tell the employer how to get the contribution details to you. So they will use that when they're submitting their details. The back-end systems will then marry up that that's your fund, and it will transmit the data to us. So it's just a back-end recognition tool. So if you've got staff, you need to be talking to your payroll software provider about when they're going to be online for this. If you're just using Mile or Xero or something along those lines, I believe a lot of those guys have got information on their website available. If you are using a specific payroll software, then you might need to give them a call and have a chat. From a super fund perspective, we already have this process going along. We will get all of your funds registered. We'll get everyone with an electronic service address. And as soon as we have those details, we'll be posting it out. Hopefully before 30th of June, we're told within the next couple of weeks it should be available for us to start registering. I'll hand you back over to Fred to go through those super fund penalty regimes.
Okay, so It starts effective 1 July 2014, so it gives the power to the ATA to issue penalties to trustees of self-managed super funds. Currently, with any non-compliance issues, so if you've got a non-complying notice, the maximum rate of tax is 46.5%, so very extreme. You could have a civil penalty. The trustees could be disqualified, or the tax office may issue an enforceable undertaking, means that you need to fix the issue within a certain time period. So, fairly hard for the tax office at the moment to actually look at the breaches, determine whether they're actually minor breaches or whether they're major breaches, and fairly costly and inefficient for the tax office to actually look at penalising the trustees. A bit of data for the 2013 year, there was 150 self-managed funds that were made non-complying. 440 people were disqualified from being a trustee. 191 funds were prevented from entering the system. So that's probably not too good, is it? 70 funds were wound up as part of the audit activity. 513 enforceable undertakings, and 438 funds were removed from the super fund lookup facility as they were investigated. So in total, there's about 500,000 funds, super funds. So there hasn't been a lot of activity, but with the new penalty regimes, it's going to really ramp up. So it's really just going to give greater flexibility for the tax office to look at non-complying issues and issue penalties. They can do that within 3 mechanisms. So they can give you a rectification direction. The education direction is that you've got an online exam, so you actually just go online and you ask you a series of questions and make sure that the trustees actually understand the rules of operating a super fund. And the third thing is an administrative penalty. So with these penalties, the trustees are personally liable, or the director of the trustee company is personally liable. Importantly, any penalties that are incurred must be paid outside the super fund, so they're borne by yourselves personally. An example of some of these, so there's rules here on the left-hand side, what the actual issue is, and the administrative penalties. So if you're not compliant with the operation standards, a $3,400 penalty. If you don't prepare your financial statements, it's $1,700. So if you're not lodging your tax returns on a year-by-year basis within the required time, then you're looking at $1,700 there. The major one there is Section 65. So the super fund shouldn't be lending any money to relatives or members themselves. That's a straight breach. The penalty for that is $10,200. So that's per offence. So if you're doing it multiple times during the year, you're racking up some quite big numbers. Section 67, so the super fund shouldn't be borrowing any money unless it's through a limited recourse borrowing arrangement or some special conditions. So it's $10,200. Section 84 is contravention of the in-house asset rule. So if you're actually lending money through to an associated entity, and if that exceeds 5% of the balance of that fund, it's $10,200. If you don't keep your trustee minutes for at least 10 years, $1,700. So Marsh and Partners will obviously be keeping all your trustee minutes, and that's why we generate the minutes each year. So that one should be okay. There's more penalties here, so fund to keep. Sorry?
These are updated changes to the penalties.
We've never had a bill before. These were from zero to these numbers here.
Oh, okay, good.
So the maximum penalty beforehand was a non-compliant fund, 46.5% of the tax.
We're not trying to gauge value or anything on these. This is the new.
Yep, and these are automatic penalties. So if I've got one of my funds, Terry's doing the audit of the fund,
so
if he says, okay, you've actually made a breach there and you've lent money out to the associated member, yourself, then Terry's going to say, yes, there's a contravention, and he's going to say the penalty involved in that is going to be X amount. So
previously he's just written that in his audit.
Yeah, he's just written that as a management letter issue that needs to be fixed up.
Yeah, okay.
But potentially if you're lending money there, it's going to be $10,200 there. And Terry's got an obligation as the auditor to report it, so that's the automatic thing.
Yeah, okay.
There is a chance that you could actually just go back to the tax office and get a remission of that penalty, but that's obviously the administration and who the person at their tax office and how that actually pans out. So yeah, quite a few penalties there in relation to the administrative. Also one here, failing to comply with the ATO directive. So if you get the directive of saying you need to do something online, the testing, and you don't do it, and they hit you with another penalty of $850. So this is all new stuff. Individual trustees versus the corporate trustee. So there's some differences there. So if you've got 3 individual trustees for a super fund, then all those penalties you're going to be multiplying by 3. So you do one breach, lend to a member, so it's going to be $30,600 per each time you've actually done that breach. However, if you've got a corporate trustee, then the directors are jointly and separately liable, so therefore you only have one penalty. So the difference there between having individual trustees and corporate trustees, and that's why over the years we've suggested corporate trustees. Also within your packs there tonight, there's just an estimated potential penalty based on the 2013 year. So there's a page within your documents there that just gives you an idea of if the tax office had a look at it, there might be a potential penalty at this stage. Okay.
Right. Okay, yeah, so one of those items that we had there, I'll just go through this back there's this one here, not compliant with operating standards. This is anything else. So that's the cover-all. Our understanding is that if you have the wrong name on a document, so if I've got Terry and Jessie Brewer as trustee for the Terry Brewer Superannuation Fund, and I've got that as the name on my Westpac shares, but I've now changed it to be Terry Brewer, pricing it as trustee for the Terry Brewer Superannuation Fund, $3,400 penalty. So we've got clients who have got over potentially $100,000 penalties because they've got the wrong names on their shares or their bank accounts or their life insurance policies. Okay, so that's why that scares the living daylights out of us.
Traditionally, you wouldn't have written that up in your audit report, would you?
No. Previously, at present, what we've done is we have given people 2 levels. One is a contravention report, which is you have been very naughty, and that's actually normally is with these ones here, where you're over the 5% in-house asset rule, or people have gone into overdraft. So people have gone into overdraft, your super fund's not allowed to borrow unless you do it specifically to buy a property. We have a lot, not a lot, but we've done 10 or 15 contravention reports last year out of the 200 super funds we look after. So with those ones, those contravention reports that we've done in the past, they're all up for $10,000 a throw. Now some of those ones, someone's gone into overdraft 4 times in a year, and it might have been $500 at a time, and it's there for 3 days, because they might have had an insurance payment go out of $2,300, and 2 days later they had a rental income come in of $3,000. So I can see that they had it covered. I've actually got to put in my contravention report they've done the wrong thing. This year, coming up, that's 3 lots of $10,000 penalty, we think. And if you've got two trustees, that's a $60,000 bill. So we want people to let people know that that's what we think we're up for. Because if I don't do that, if I don't put that in the report and the tax office then catch and audit your return and then say, hang on Terry, you missed it, it actually can impact on my tax agent's licence. So it's very serious for us. So we don't have a lot of room. So therefore we're going to be giving people some pretty nasty letters there. So at present, in the past, we've done a contravention report or what we call a management letter. And in the management letter, that's where we've said, you've got your insurance policy in the wrong name, or you've got your shares in the wrong name. Please change these specific shares, or please change the name of your bank accounts. Some people have tried and so they can't do it anymore. We need a copy of the letter that they've sent off to the tax to the bank or the shares guys to say, right, we've tried to change the name and we've been unsuccessful. At least I've got an excuse that we can then go to the tax office on. Again, with these penalties, we don't know. We doubt that they're going to be. We expect that they'll be able to reverse most of these penalties relatively easily in the first year or 2, but later on, they're going to be standing pretty hard term on them. So I'd much rather let people know now and let people know why we are worried about this. So one of the things we're looking at is obviously, if I've got some clients who've got 4 members in a fund and I've got 4 individual trustees. So 4 lots of $10,000 adds up pretty bloody quick. So we think that's probably a good idea to have a look and appoint companies as trustees of your super funds. So everybody should have an ND diagram in there, and on there that will tell you whether you have individuals as trustee or a company. If you've already got a company, you don't have to worry about this, you're already covered. So the reasons to go to a company is, one, to minimise these penalties, and the second one is looking at what, and this is the main reason to do it, the second one is what happens if someone dies. So at present, if I've got Terry and Jesse as trustee for the Terry Brewer Super Fund, and then I die, all of a sudden, I've got Jesse as trustee for the TJ Brewer Super Fund. First of all, not allowed to have a single person as a trustee of a super fund. So we've got to turn around and find a family member, so a brother or sister or a parent or a son or whatever to join in, or change it to a company. So that's number one. Second thing is, I've got to, no matter what I do, I'm changing the name on the top, and therefore I've got to turn around and change all my bank accounts and all my shares and everything like that. It's a bit of a pain in the neck to do. And the third thing is, I'm doing that when hopefully Jessie's a little bit sad that I've gone. So she's not really thinking about it. That's not the top of her agenda. And all of a sudden I can then, the auditor of the super fund, if that doesn't happen for 12 months, we turn around, we hit someone with a $30,000 or $50,000 bill because they've got the shares in the wrong name. So we would much rather go through the pain and the hassle of getting things changed now, before there are penalties if we get things done too late, and while everybody's alive and in good working order. So that's the reason to make changes now. The other reason to have with a company, you can have an existing company, or you can have a brand new separate company as trustee. The roll gold system is to have a brand new separate company as trustee, and that's to ensure that you don't get yourself mixed up between Terry Brewer as trustee for my super fund and also as trustee for my family trust, so I don't get those things mixed up. It's one thing for me. It's also more importantly that if my family trust went bust and I've got an external administrator or liquidator in charge of it, he doesn't think, oh, hang on, these Westpac shares over here, which are in my super fund, they've still got Terry Brewer proportionally as trustee. So that's the reason to have a brand new, a clean, separate company as trustee, or something that does nothing else. Of course, it's more expensive. So what are the costs involved? To turn around and change the trustee of your super fund, it's $450. We actually do that through McCulloch's here. And if you were to get a brand new company, as a superannuation fund only company, is $750. So you might have a spare company floating around that's not doing anything. You don't need that cost there, which we possibly will need this one. Remember that if you've got a company as trustee of the fund, every member must be a director. So if you've got 2 members of the fund, you've got to have those same 2 people as directors. If you're using a spare company, you may only have 1 person as a director. We would have to add the second person in if we're going to use a spare company for you. Okay, if you turn around and change it, what have you got to do? After you make the change, we've got to, if you've got life insurance inside your super fund, you've got to change those life insurance details. Talk to your life insurance agent about that. You've got to change your title deeds. If you've got land in there, and you talk to the titles office, so we can put you into a solicitor who can organise that. Standard price here is about $750. You can do that yourself as long as you don't screw it up. And then changing to your shares. So again, if you're dealing with a stockbroker already, you can actually go through there and they'll do it for you. I know we dealt with Morgans a little bit, and they can do this separately on a case-by-case basis. That's what they've got a little division. That's all that they do. And it's $75 per holding. You need 100 points check or whatever. So there's various bits and pieces that can be done that in case you do need to go down that track. Right, yeah. Okay, one last one we're going through here is just with changes for life insurance as well. So each superannuation fund must have what's called an investment strategy, which is basically saying, this is how I think I'm going to invest the monies that I've got available in the super fund for the retirement benefits of the members. Now, going forward, we must have included in this talking about life insurance. So we actually have to consider, as part of that investment strategy, whether you need to have life insurance as part of your superannuation fund. So you don't actually have to make a decision to do it, but you actually have to be able to prove that you thought about it. So we'll, as part of next year's documentation coming through, there'll be a piece of paper in there basically saying that yes, we've looked at the idea of life insurance, and either yes, we've already got it, we think we've got enough, we're going to do something about it, we're going to put some more in, or no, we don't think we need any more, we don't need any life insurance inside super, because either I'm too old and it's too expensive, AMP are just going to rip me off, or I've already got life insurance outside, or I don't have any debt, I don't need any life insurance. Okay, so if you are going to get life insurance, why would you possibly want to do it inside super? So the main thing is that the life insurance premiums are a tax deduction inside super, and they're not outside super. So that's the big reason why people have been putting life insurance inside super over the years. And with this one, if you are talking to people and even employees and whatever, a lot of people are moving to self-managed super funds, and they might be moving away from someone like Sun Super. Remember that if you've got one of those big funds, they may already have life insurance as part of it. That might be part of the reason why their fees are so high. But if they move from a Sun Super into a self-managed super fund, and they all of a sudden go to a place where your self-managed fund does not have super, then maybe the widow may have just lost out on a $300,000 life policy if you die 3 weeks later. So that's something that you've got to think about as well when you're moving to self-managed. That's something we've got to be very careful about when we're talking to clients, to make sure they don't lose an asset that they've forgotten about altogether. You can have total permanent disability inside super. Can't be done every time. So you've got to talk to your life insurance agent about that. You cannot have trauma insurance inside super. So the main thing is to talk to your life policy about it. Right, I'll put you over to Fred again.
Okay, last section for tonight. We're just looking at the compliance process and trying to streamline what we're doing at Marsh & Partners. So last July, everyone would have received their white binders in the post, and that was broken up into months, so July through to June. So everyone, we're already in May, so everyone would have already been collating all that information on a monthly basis. So that folder would be just growing immensely by now. All the buy and sell contracts, any purchases, all the documentation would already be in there. So that's good. I suppose then we can, when we get through to July this year, most of the information will be sent through to us, and then we can start doing some of your super fund work. So we're just trying to make that a little bit easier for you to collate the information during the year. Within your seminar packs, there's an authority form there to release information. So maybe there was some information during the year that you've misplaced or something like that. So if you sign that form there, we can just contact your broker or your lawyer or any other person there to get information directly rather than harassing yourself. Also within there, there's a broker contact detail pack. So if you're looking at, if you're doing buy and sell contracts, so the idea there is to provide the broker details, and we can talk to the broker, and we're just trying to get all the information automatically via electronic means rather than trying to get the manual transactions. Also bank authority forms, so a lot of you may have already signed up to some bank authority, and that allows us to get the information automatically uploaded into our system. So once again, just trying to reduce the amount of manual transaction and data we have to input into our system. There may be some additional bank authority forms in your packs for different banks that have come on board. Also in July this year, we're all the minutes of meetings, so every investment decision you've made for the last 12 months, you've had all your meetings there. Trustees have agreed on all those things. So, and there's other standard letters that we do at the end of the year, so we're just going to send those out in July. So suggestions for yourselves to consider: just review, sign, return any forms that are in your seminar packs as soon as practical, so we can get all this organised by 30th of June. In July 2014, we'll forward out some white binders for the next year. Consider documenting your decision in relation to life insurance, and if you wanted to, just attach your relevant life insurance policies in there so we've got the information. Within your packs also is the management letter from last year, so within that there may be things that you need to address before 30th of June in order to get rid of those estimated ATO penalties. So we're just trying to ensure that information is done on a timely basis and trying to mitigate any sort of ATO penalties going forward. So most importantly, if you've got any questions there, contact myself or Terry, Cameron and the other account managers at Marsh & Partners. They would be happy to help you out. So.
Yes, and as you can see, to get the little PowerPoints in your pack so that you could write on them, very, very tiny. So if you would like larger versions, if there's things in there you think, oh, I'd like to see that in bigger font, just let any one of us know, the partners, the managers, anyone that you've got a Marsh & Partners email address for, or just ring up and say, I want a bigger copy. And I'm PDFing them and sending them out, because for people like me who can't read them without worries, you might want bigger copies. If you do, or to sit down with someone else to go through it, a couple of people did that, we're happy just to send it out PDF form.
And if you have any questions, we'll be around for another couple of hours, Terry, aren't we? To answer any questions and
Yes,
mitigate any penalties. So,
yep. Tea, coffee, juices. And you did tell them where the facilities were, Terry, at the beginning, didn't you?
No, I didn't actually.
So ladies, I really recommend a visit to the ladies. It's really nice. Out the door here and round to the right, ladies, we're nice and close. The men is out to the left, down the corridor, and left again. And I'm sure that'll be just as lovely. I could try to get out.
Right, yeah, thanks for coming tonight. And,